Adam Newman convince people that WeWork was a tech company?
And he got more money for his next startup after all the shady crap he did. Okay,
Yeah.
I wouldn't try that. I wouldn't trust that man as like a valet at a mid-priced restaurant. On the fundraising side, I always tell founders that VC money is the least worst alternative for a certain type of startup.
Andrew,
Now,
when we were speaking earlier, you said that startups are like a chain and not a rope. Why is that?
sure, visualize a rope. You're holding a rope in your hand and you're looking at the individual strands, and a couple of them are frayed, but most of them are okay. You can use that rope. It'll bear the load. Now visualize a chain instead. If any one link is broken, the chain is useless. It can't carry a load. So when I talk to founders about startups, they're like, oh, our market size is great and this, that, and the other thing, but this one link is broken. Like you don't have a go-to-market that's going to work. Or I don't think your problem is, really widespread and frequent and painful. I don't need to look any further. Right? It doesn't matter if the other 12 links are sound if one link is broken.
And so realistically, having worked on startups, run startups, it doesn't feel like we ever really have the full chain sorted out, right? Like you sometimes feel like you're holding on to one link and then another link and then the other ones are kind of rusty, blurry, non-existent. Like it's not that neat in my experience.
Sure. So let's like drag this analogy a little further along. Right? The chain needs to support a certain amount of weight. The further along your startup is, the more weight I, as an investor, expect that chain to hold. So when I was an angel investor running accelerator programs, if some of the links looked a little bit weak, but I figured I could work with them and they were fixable, that was okay. It only had to carry a little bit of weight for that point in time. And the later I get in the program, the more I expect that to be a robust chain capable of carrying the weight that it has. By the time you say a Series A startup, I want those chains to be pretty damn strong. And like if the sales economics are weak but getting better, like okay, I'm all right with that link. But like the other links have to be rock solid at that.
At the beginning, what are the links that you basically can't progress without?
Sure. Let's the super basic ones, right? If you don't have a problem that is really painful, right? It's not like, oh, I got a hangnail. It's like, boom, I hit my thumb with a hammer and it hurts like hell. It's not painful if it's not prevalent, meaning lots of people have it, and if it's not frequent, you're going to run into problems right there on your problem slide. You can sometimes get away with two of the three. So like the example I give is college admissions. It's a super painful and stressful time for people. Most people have it, so it's pretty prevalent. But with luck, you only go through it once in your life. But that's harder. Really, you want to score strongly on all three. And if you don't, I don't need to read the rest of the deck.
And so is it the same when we're thinking about corporate innovation as well? Is it that those, when there is somebody in a corporate who is thinking of, pitching a new line of business to the CFO, is it essentially those three things, or is it slightly different when you have corporate money behind you?
So it's different. It's different when you look at it from the investor side of the fence, right? So as a startup, you want to create that chain and you want every link to be strong. You have to work on all those links. As an investor, you're deluged with lots of startups pitching you, ideally with warm intros, not the cold emails. You don't even waste your time with those. So one of the things you need to learn how to do very quickly as an investor of any type is do that quick filter. Okay, I've seen hundreds of startups that target architects. They're cheap and there are not that many of them. I'm going to skip right to the market size. And if the market size and the revenue model don't make sense, I don't need to look anywhere else. So you learn to have that fast filter. Now, when you layer on top of it that you're corporate, you got to do a bunch of other things. You have to do all the things that a regular investor has to do. But then you have to sweat things like the strategic fit. You have to sweat things like, do I have champions within the organization who will actually pilot with this? And when you take it up to even higher level and you're setting these things up, you have to think about the processes and the structures that support it. Like it's one thing to say, oh, I'm going to get connections to the line of business, but like the line of business, this is not anything that they're not bonus, they're not promoted for the number of partnerships they do. So when push comes to shove, like they want to hit their numbers. So if you're really setting all that up, you have to think structurally about how do I achieve all my goals as not just a VC fund, but a corporate venture fund. I don't know. I guess it's a chain, but it's a different type of chain.
I wonder, do you think that's one of the reasons why corporates find it so hard to innovate? Is that actually you can have all of the traditional startup ideas, so they can be the problem, they can be the market size, all of that stuff to a sensible investor who's not involved in the corporate politics. That looks great. But, if, I don't know, sales and finance hate each other and you need to get finance on board, it's just not going to happen. Do you think that's one of the reasons why
Yeah, that's
corporates
definitely
struggle?
one of the big reasons. And let's actually take it up a level, right? When we talk about corporate innovation, we're talking about a toolbox with a lot of tools in it. On one extreme, you've got just your regular R&D department, and that's traditional. Most corporations know how to run it. Whether they do it well or not is a different story. There's no great novelty to it. People know how that works. Then as you move a little bit more into like the cool startup-y stuff, they start thinking about venture studio, which is kind of new to a lot of corporations. And it's actually a brutally hard model. It's everything that's hard about VC and accelerators, but harder because it's earlier. And for those of you who are kind of just tuning in, a venture studio is some variation of, hey, we have all these interesting ideas. Maybe we can make startups internally about it. So they're trying to stand up a team that's kind of in but not in, trying to replicate the startup experience in one way, shape, or form, kind of in or on the margins of the company. And we can go a lot deeper on that if you want. But then the next step over is doing an accelerator, which is also a very, very heavy lift. And usually the advice is don't do it. It doesn't make sense for you. And then you got, I want to do corporate venture. So corporate venture is what we started talking about before, where you got all the VC stuff, and you're layering on top the strategic element to it. And most corporate ventures, though in theory they're a very strong platform and should be advantaged relative to a VC fund. I mean, Sophia, hey, you shouldn't take their money, you should take my money because I can give you money for investment and I can get you revenue with the line of business, right? That's differentiating.
Yeah, it's an attractive proposition.
But then they drop the ball on the actual getting pilots and revenue part. So, and there's a lot of root causes for that. So in theory, it's super strong. In practice, 95% of the time, they drop the ball on what are kind of subtle nuances in many cases.
Yeah, I remember in my last company, we actually were in this corporate accelerator. And we joined basically not because we wanted any knowledge from them, because like I didn't think that they would give us anything that useful. But at the end, there was going to be, contract with this very large entity, and everybody else in the accelerator was there. We basically just sat through whatever lessons they wanted us to learn, which actually we could have taught much better. But at the end, we're like, just give us the money. Give us the contract.
It's like the song by the Who's, right? How do you get your pudding if you don't eat your meat? You're like, I'm just going to sit there, have my broccoli, and then maybe I get dessert. Let me guess, you were absolutely right about not learning anything from the main program, but you were wrong about getting the contracts. Because at the end of the day,
exactly.
they didn't come through most of the time.
Yeah, they didn't come through, but now I get to talk about it in a podcast. And so you mentioned that accelerators are not a good idea. Is that for the founder or for the corporate? Who are they a bad idea? Or for the investor?
Often all around, but like there are exceptions, right? So it's like, 95% of the time, don't do it. But if you meet certain criteria, yeah, it's the right tool. It's like a tool chest, right?
Mm-hmm.
Like sometimes you need a Phillips head screwdriver, sometimes you need a flathead, sometimes you need a ratchet. And if you bring the wrong tool to a project, you're just going to make a mess. So I'll unpack that a little bit. Let's go from the founder side. Okay. Most accelerators, like everything in life, are kind of same blah, but different. Right? You're not going to get that much. Actually, let me roll it back. I'm going to start positively. We've talked about the book I wrote, and we can go into that in more detail if you want. But I actually write about it in that, where the founder, I write it as a novel. So the founder is like going through his life, and he's actually in his martial arts studio sparring, and he's trying to ponder the idea of should he take an offer to join an accelerator. And it occurs to him that thinking about an accelerator was kind of similar to how he thought about what studio to join. Right? So first you need to figure out what you want from it. So some people go to a martial arts class because they want to defend themselves. Others go because they want the fitness. Some people do it for the social, right? And it's the same thing with an accelerator. So if you're a super early stage startup and you just need to know what it takes to run a startup, like, okay, you need those basic blocking and tackling skills. That's one thing. If you're a little further along and you kind of like built the startup, you got that. But you need to know how you scale sales, right? You've just been doing like founder-led sales, and now you know how to build a sales team. Well, that's something else. You need those introductions. You need that set of knowledge. Or if you're, you got maybe the first two, but like you don't know the first thing about how to raise an institutional round, then you're joining the fundraising, the network, the skill that it comes with finding and landing investors. So once you know what you need, it becomes easier to figure out like what's the right accelerator for you. And then the questions that, the founder in the book asked the different, about the dojo, about how their style works and how they what they consider success, you can think of similar questions that you would ask an accelerator program. So through a later stage program focused on driving sales, we want to talk to them about like, how many introductions does the average startup get, right? How many of them actually generate sales? And those may be hard questions for the accelerator to answer, but how they answer them will tell you whether or not there's value for your startup in that particular accelerator.
And sometimes it does actually work. So I'm an advisor to a company called Riveter, and they use AI and visual search to predict consumer trends. So they can basically say, okay, this particular shade of blue is going to be really popular in 3 years. So, Inditex and L'Oreal, start preparing for it now.
Very cool.
And the founder, who has been on the show a couple of times, she actually used accelerators to build the business without going to investors. So, at the beginning, she just needed some. At the beginning, she went to an accelerator to find a co-founder.
Mhm.
Then the next one, I think basically there was just some money that if they won first place, they got some cash. And then another one, it's called, I think it's called Founders Factory. I'm not sure. But anyway, I know that it's based in London, and they used that to get their first big corporate contract. And that was a contract with L'Oreal. And obviously L'Oreal is huge and very well known, and also has, very high French standards. And so if you survive, working with L'Oreal, then all the other beauty houses basically take you very seriously. That really helped her business. But that particular accelerator, that's all they do. They basically say, come work with us and we will connect you to our corporate partners. And they're pretty good at it. And so I wonder, why is it that, some accelerators actually do what they promise and others don't?
Well, so part of it is just some are better at what they do than they are. Right. Now, there's also, it's similar with VC funds, but especially with accelerators, there's a bit of a virtuous cycle to them. It's like a network effect almost. So the best startups want to be part of the best accelerator programs or VC invested by the best VC funds, and the best investors want to be connected with those accelerators because then they find the best startups. So it becomes this virtuous cycle where once you're the best at something, everyone wants to be part of it, and that includes corporate partners. There's certainly an element of skill to it, but it becomes very hard if, like, you're trying to start an accelerator now to compete with the people who've already done it before for a long time. And that's kind of the same reason why Craigslist still exists, right? It is an ugly interface. It has been ugly for 2 decades, but marketplaces are that strong. So if you want to come in as an accelerator, and I would argue if you want to come in as a VC, you got to think about what differentiates you as your program. You actually have to hold yourself to the same standards you're going to hold your startups to. It's got to be a quantum level better. It's got to be visibly and obviously different than what everyone else is doing. Because what you don't want to do is you want to go out there and the best startups who have their choice of who they want on their cap table, or which accelerators to go to. You don't want them to see you and think, that looks like every other accelerator I've looked at, just with a different logo.
And so, in your view, do VCs genuinely add value, or is it just, handing out cash, which is a commodity product?
So the answer is yes, but, and no, which is my way of trying to avoid the VC depends. We talk about the VC soft no, but VCs say the word depends more than any other word out there. But the answer is it does depend. Right? So there are some VCs that absolutely deliver value. Actually, I would say many VCs deliver value, but do they deliver fundamentally different or much more value than the other VC that you could have taken money from if you had the choice? And in many cases, the answer to that is no. So what's your typical pitch if you're like the generic VC? It's, hey, we're 2 or 3 former founders. We did really well. Now we want to take it to the next level. So we did some angel investments and now we're turning it into a fund. And we can help you with all the issues you're going to come across as a founder. And we have great networks and we'll make introductions to you, just like every other VC that startup has spoken to. So, they actually haven't held themselves to that standard. Like, what can they do different and better? Now, the exceptions are some of them who really are different and better, the ones that are more established, so they have that virtuous cycle going for them, and then the ones that have actually sweated the details and built platforms around what they do that are meaningfully different. So corporate venture is a platform. If they do it right, it's a good platform. Accelerators are a platform. They're basically a VC fund with a heavy, prologue. And if you do that right and differentiate yourself as an accelerator, that works well. But there are other platforms out there that exist or can be developed that a startup would look at and be like, Andreessen, move aside, make some room for these guys. We need them on our cap table. And that's the goal you need to shoot for, because that's a quantum level more value than your competitors as another VC fund.
Do you think that we're now, so actually I'll tell you that I think this and then you can disagree with me if you like. So I think we're now at this time in the market where fundraising is so glamorized that people want to fundraise without necessarily knowing why. And, I was just reading a newsletter, I get startup newsletters from various different entrepreneurship hubs, because obviously we're doing a lot of work in the Middle East and so on. And I'm getting this newsletter and I'm just scrolling through it and it's just, okay, this company has raised this much and this company has raised this much. And I'm thinking, this is terrible. Good for them, but the signal that it sends is that you only become newsworthy if you convince somebody to give you money for something that might happen later. And I don't know, that just makes me think of, some people are really great storytellers. Like Adam Newman convinced people that WeWork was a tech company.
And he got more money for his next startup after all the shady crap he did.
Yeah.
Okay. I wouldn't try that. I wouldn't trust that man as like a valet at a mid-priced restaurant. I mean, okay, sorry. No offense. Let's move on. I agree with you 100%, right? There is no fun in fundraising. And the people who actually know that the best are VCs, because we have to go raise money from LPs. And if you as a startup think it's hard to raise money from a VC, oh my God, try to raise money from LPs as a fund. I mean, that is brutal. And in part because we don't listen to what I talked about before, right? We're actually just trying to sell a commodity type approach. And the LPs have seen a zillion decks that look like that. Again, just with different logos. But I digress. On the fundraising side, I always tell founders that VC money is the least worst alternative for a certain type of startup. Not all startups are good for VC, right? They might be slower growth, they might be smaller markets, but you can still make a ton of money as a founder. And if you're going to try to raise VC, again, you're trying to get a hammer when what you need is a screwdriver. You need different types of funding. If you can fund...
And also, there are very successful businesses that become big businesses without any external investment.
Yeah, or they bootstrap for a long time before they raise. Yeah, so you have to ask yourself this, right? What does the VC want and what do you want, right? So a VC is looking for companies that can return 10, 20, 50, 100x. We need it, especially early on, because we know, if a third of our portfolio goes to zero in 2 years, we're doing pretty well, actually. Right? We need those big wins. Isn't it 1 in
10? You basically need 1 in 10 to keep
I like to say that I need at least a third of my portfolio to do reasonably well, right? So for me, a third, if they go to zero, okay, happens, right? And if a middle third get a 2 or 3x or even a 4x return in 8, 9 years, that's kind of a loss for me when you think about what that translates into as an ROI basis. So I need the rest of my portfolio to be doing 10x on average, a little bit more, a little bit less, depending on the stage and the whole time. And within that third, it really helps a lot if one of them's 100x.
And so that means that founders have to be very focused on exit. And so that's either acquisition, or IPO, probably most likely acquisition. And that's also being really glamorized, but maybe that's not necessarily what you actually need to do.
I'm going to disagree with you on that one. I would say when I see a startup coming in with like an exit opportunity slide in at a seed stage or Series A, it's kind of a turnoff for me. It telegraphs to me in a weird sort of way that they're coming at this from a mercenary perspective rather than a missionary perspective. Like the ones who come in and said, I started this health tech startup because my mom was getting, radiation for like breast cancer. And I saw the way they were doing it. I'm like, oh my God, I can't believe I'm trusting my mom to this. Those guys are going to plug away at this forever, maybe even longer than they should because it's a mission for them. The ones that are focused on like the exit, like going's going to get a little hard. They're going to get like, a $300,000 job offer somewhere else. Like, I see, I'll do something else. So sometimes the focus on the exit is a negative signal, but instead focus on your total addressable market. If your market is $1 billion market or more, now we're talking this potential for 100x returns. And if you got a go-to-market that's as clever as the startup is itself, and you have a chance of growing, doubling, and tripling for those first couple of years, which means you'll get to that point fast enough for it to make sense for a VC. If you don't hit that criteria, don't despair. There are tons of people that made a lot of money with different types of businesses. Right? And even if you do hit that criteria, if you have other alternatives, maybe you do those first. Like maybe you can do just traditional bank loans. Maybe you can bootstrap off of revenue. Now, you may be in a situation where you could, but then you're like, well, I could grow slower with revenue, or I could take money and grow faster. Now, that's an awesome place to be in as a founder because you don't need money at that point. You want it. And that makes VCs like, that's a catnip for us. I don't need your money, but if I have it, I can grow faster. It makes us like want to shove it at you.
It's like being really happy single, basically.
Yeah, and then you get all the dates you want.
So it actually reminds me of this company. It's an e-commerce company, and they had been growing, sometimes growing slowly, sometimes fast, but for 13 years without any external funding. And then they raised their Series A 13 years in. And by the time they got there, and it's called high snobiety. So it's high fashion for men. And they got their first investment at Series A from Felix Capital. And I remember I saw both the investor and the founder, and the relationship between them seemed quite healthy. Like, they both had professional respect for each other, and they both understood that the other one was doing things that the other one couldn't do. And I thought that's a very good, healthy relationship, and it actually looks like a mutually respectful partnership. Whereas I find that if people are going too early, the power dynamic is just weird. It's just off. It's like when you see Donald Trump and Keir Starmer in the same room. You can even just tell by the body language, okay, who is the one in charge.
Yeah, I'm going to have to take your word on that one. The last time I was there, I couldn't see past the other glitterati to see Trump himself. So, no, you're right. There's a definite power imbalance. And if you think about it, like a VC, even like just your run-of-the-mill VC is seeing hundreds of decks a year. And if they invest in, say, 10 each year, they're doing multiple transactions a year. They're just going to be better at that kind of thing. Even the ones that are relatively new at it within a year or two are going to have an order of magnitude more experience with a bunch of things than the founder does, and especially when it comes around the fundraising process. What's different in the case you did is you had entrepreneurs that had kind of deep experience in the space. They built something, and it was they wanted but didn't need situation. I'm sure they had this kind of conversation. Like, we keep doing this for a while, but if we take this extra money, like, we can hit this inflection point, and God damn it, let's try shooting for the moon. So it's a different dynamic in terms of the maturity of the founders, and the need for each other is a little less asymmetric.
Also, I think just your confidence level and the fact that as a founder you can just handle unpleasant situations, because if he'd been running his company for 13 years, growing it, and we spoke, and he said sometimes it was going well, other times it was terrible, and I thought the whole thing would fall apart. And if you've been going through that and persevering and actually managed to get it to a point where it's everybody, by the time he got investment, his brand in the industry was very well known. He had great sales. And so by that point, if your VC isn't very happy with you, you can kind of handle it, I think. You can handle yourself as a person. And so for the power dynamic to be in the founder's favor, what does the founder need?
So for most cases, you just can't do anything about it, to be honest. So you want to really vet your VC as much as possible. It's like you can go out and find, if you have the choice. If you have no choice, you just got to be like, I take the money or not, right? But if you're able to run a good process and you get multiple term sheets, and I give like an hour talk on that. But if you manage to get to that, then you really want to diligence your VCs and understand how their portfolio companies feel about that. And most importantly, it's not their successful portfolio companies. It's the ones that are going sideways or that fail. The ones that may not be on the portfolio page anymore. So go back, look through Crunchbase, use the Wayback Machine to see what was there 2, 3, 4 years ago. Talk to those founders. Because how the VC treats those founders is a good indication of how they are when you're not their darling child. I want to roll back to one point we talked about before. For many people who are going to be a first-time founder, and most of them are probably in corporate roles right now, and they have this idea, it's a pain point they deal with every day, and they're like, oh my God, I think I have a better way to do it. One of the things that they don't know, and that's the hardest for them to figure out before they jump ship, is what does it actually feel like to be in a startup from a day-to-day perspective. You don't have anyone filling the coffee maker in the morning for you. If you want to get an office, you got to buy your own desk. Like, we assembled our own desks And I don't mean a Kia assembly. We built them from wood. Over here, I had splinters for the better part of a year because we were too much in a rush to actually sand it properly. Like that's a huge difference. So, that's part of the beef I have with a lot of business books out there, other than the fact that they're deathly boring the way they're ghostwritten. It's that it can give you an instruction manual, but it doesn't give you the feel for what it is. And as Steve Jobs biopics make it seem glamorous, it ain't like that. That's part of the reason I wrote my book like a novel, because I wanted people to really get a feel for the highs and the lows of being a founder. And if it's not for you, then okay, at least you know it's not for you, and you haven't wasted 3 years of your life and maybe side-railed your career.
So let's actually try to give people some lessons so they can know when it's not for them, because I agree with you that there's so much glamorization. So what are some signs that the startup life is definitely not for you?
Okay, for a large period of time, you're going to be looking at your monthly bank statements and they're going to be going down. Your personal monthly bank statements, then your business. When you have your business and when you're in personal, you're going to be looking at it, and I have these many months of oxygen left. If something doesn't pick up, if I can't raise more money or if I can't, boost my revenue, I'm not going to make payroll. I went actually a little over a whole year without salary when 9/11 happened, and the VC that had given us a term sheet, who was based in the World Trade Center, just disappeared overnight, literally disappeared. So we went a year without salary. If the prospect of that makes your diaphragm seize up and you're short of breath, this is not for you. And I don't mean that in a bad way. Like climbing Everest is not for me. I get it. Like happiness is knowing what you're going to be comfortable with. So don't become a founder because you think it's cool to be a founder. You want to be a founder. Really try to put yourself in that position in 6 months or a year and understand, like, is this the kind of thing that like I'm going to lose my hair over and like need counseling for? Or is this the kind of thing where like I can do that? I'm willing to risk that. And if I lose a year of income, it'll be okay. Right? I've got a spouse or a partner whose healthcare I can be on. I've got my parents if I'm young enough that I can fall back on. If it doesn't work, I'll have learned a lot. Like if that's your attitude, then it's a better fit for you.
I have this theory, don't know if it's correct at all, but I have this theory that people who are really good at thriving in corporate and really good at climbing the hierarchy, that's a very different talent to the talent
Absolutely.
of an entrepreneur. And for example, I don't think I have that talent. And where I do think I have the talent for entrepreneurship. And so I think that if I were in a corporate, I don't think it would be, I mean, it wouldn't be pleasant for me, but I don't think I would get really to the top because I think I would say a lot about what I really think, and in corporates, you're not allowed to do that.
Yeah, so there's more than that too, right? There's in everything in life, there's a trade-off between precision and polish versus speed. So in corporate, where there's a lot of finger pointing, the company's not going to move that fast anyway. In the best of circumstances, you're prioritizing a little bit more for precision and polish, and also building alliances and all that kind of stuff. In a startup, like your alliances is your co-founder across the table, so that's a conversation, and you're trying things that are so different that it's not efficient to polish it. Just test it, right? And I can go out there and talk to 100 customers, put something up there, it doesn't work, I take it down. The world didn't notice. L'Oreal, if they put out, oh, we're just going to try it, and we're going to try like puke green. I'm like, oh, that was a mistake. Well, that hurts L'Oreal much bigger in the long run. So they have to be more cautious. They have to like dot all their I's and cross all their T's. So they are very different skills. In fact, probably the profession that trains you the worst to be an entrepreneur is law. Because in law, you have no incentive to get a deal done fast, right? No lawyer was ever promoted because that deal happened in half the time. But they have been fired if something they missed, which was a totally obscure 1 in a million chance, happened and it hurt their client. So they are drilled from the very beginning to spend as much time as possible, which they can bill for, right? It's just the opposite for startups. Spend as much time as possible to think up every single way something can go wrong. And if they kill the deal or it takes longer, no punishment, just because they've saved their client potential risk that may or may not have happened. And that's the counter opposite of what it takes to be a founder.
If somebody's in a corporate and they are thinking, well, I do have this idea and I've been wanting to work on it for a while, but I'm not sure if it's for me. So obviously one bit of advice is get your bug. But what else could they do to figure out, to basically try before you buy?
So let's break it up to two pieces. One is that gut check we talked about before. Talk to as many real founders as possible. People who have done it for a year or two, ask them about their lows, ask them about the stuff they didn't expect before they jumped off the high dive. And there's, you got to listen to that. Does your blood run cold, or are you like, oh, I can handle that? You may still be
I would
wrong.
add to that, speak
Yeah.
to people from different levels of income. What I mean is, I remember I was speaking to a startup founder who was saying to me, yeah, like it's been hard, but we didn't get paid for 2 years. And he was totally fine about it. And then I realized he was from, one of the richest families in the country that I was in. And I was just like, oh, and he seemed to get investment really quickly. How did that happen? I was from a family office, which is
Yeah.
like, his uncles. And I wished I had known that about him because I still think he's smart. He's still doing well. But I do remember thinking, like, what? Why isn't that happening? Why isn't that
He
happening
just
to
didn't
me?
have the same existential angst that someone who has 3 kids in private school might have over like not
Yeah.
making money for a year or two. So yeah, I would say you need to qualify the entrepreneurs you work with for people who are in similar positions as you are, because that'll give you the most accurate read on it. So that's a very good point. So that's the kind of emotional, psychological preparation for it. The actual block and tackling, get out there and talk to as many potential customers as possible. The other kind of newbie mistake a lot of first-time founders, and in particular the ones that have been trained at corporate, is things like, well, I can't tell anyone about this. They're going to steal my idea. Right? So the risk of somebody stealing your idea is infinitesimal compared to the probability that you will spend way too much time and build stuff the market doesn't want if you don't get out there and hear from the market. There's a saying in the industry, more startups die from suicide than homicide. And I'll give you one other way to think about it, right? Startups are babies. You love your baby. You think your baby's the cutest ever. That other guy who may or may not become your competition, he or she thinks their baby's really cute. They look at your baby and it's like, it's not so cute. I like my baby better. So even if they did hear your idea, they're already attached to something else. And lastly, if your idea is so easy to steal, it's probably not that defensible. So it may not be maybe a good product to build, but it may not be a great investment.
Our Fun and Technical Founders program that we run, when people apply and they say they don't want, nerves about people stealing my idea, we just automatically now dismiss them because I just don't have the time to deal with that. I think, okay, watch some YouTube videos. Like you need to figure yourself out. Once you've done that, then you can come to us and learn.
I've got a standard spiel. I'll send it back to them. But they got that one chance, like, oh, okay, that makes sense. Okay, we can keep talking. But if they're like, no, if they ask me to sign an NDA, I'm like, yeah, that's cute. Sorry, best of luck.
So on this note, I will let you go to enjoy your day, and the link to your book is in the show notes.
Awesome.
And well, thank you so much. It's been a pleasure, and we've all learned so much from you.
Thank you for having me.